The next rider that we'll have a look at is the accidental death benefit rider. And actually there are two riders that are fairly closely related here. So the accidental death benefit, sometimes it's called double indemnity, and this is the frequent source of plots in movies and mystery movies and that kind of thing, where what happens, you have somebody who has, let's say, a face value of $500,000. Person is killed in an accident. If they have this ADB, normally what you'll see is another $500,000 of death benefit, bringing us to a total of $1 million. Now, it has to be an accident. The name of the rider, accidental death benefit. So accidents would exclude things like cancer, would exclude any kind of illness, or most lifestyle decisions as well. So it would cover things like car accidents, for example. But you'll find that this is a place where we do see some exclusions. In general, with life insurance, you won't see exclusions outside of the suicide exclusion clause. But normally, life insurance policies have no exclusions for things like drinking and driving, no exclusions for commission of a criminal offense. However, your accidental death benefit typically will exclude some of the things that I just mentioned, involvement in criminal activity, drinking and driving, participation in a riot or civil insurrection, if you're killed in war, participation in war. These types of things tend to be excluded from the accidental death benefit. So it really just covers the kind of routine accidents that people occasionally have, car accidents. It's a fairly inexpensive rider, but it has those limitations where it only pays in the event of an accident. It's generally not worth it, or not a wise idea, to incorporate the accidental death benefit into a needs analysis. If you sit down with a client and you figure with the needs analysis that the client needs $1 million worth of life insurance, don't sell them a $500,000 life insurance policy and a $500,000 accidental death benefit. It's not going to serve them any good. What if that person dies from cancer, for example? Well, they're not going to have this. They're only going to end up with a $500,000 death benefit. So the accidental death benefit is not a good planning tool. I would suggest you could use it in some situations, generally where somebody works at a dangerous job, for example. The accidental death benefit is not a bad idea, but be careful that you're not using this to replace the actual amount of life insurance that you should sell somebody. And normally with accidental death benefit, in order for the death to qualify under the conditions of this rider, the death has to occur within 365 days of the accident and has to be directly attributable to the accident. The next rider we'll look at is closely related, and that is the accidental death and dismemberment rider. So the accidental death and dismemberment rider, fairly similar. What happens with the AD&D rider is we essentially attach a dollar value to your physical being. And we say any loss of a portion of that physical being, that is a dismemberment, which includes, by the way, in today's AD&D riders, a loss of use. Any loss of use or dismemberment, any such circumstance, will result in a payment being made based on how much loss you've suffered. So it's a little bit morbid, but there's essentially a chart attached to this that says if we draw out the whole leg here, that maybe if you just lose your foot, maybe that's worth $25,000. If you lose your leg below the knee, maybe that's worth $50,000. If you lose the whole leg, maybe that's worth $150,000. Or if you lose the use of maybe both legs, maybe that's worth $250,000, something to that effect. There's typically a death benefit as well attached to it. The death benefit is usually equal to the most significant loss that you can suffer. So maybe a $250,000 death benefit, maybe a $500,000 death benefit. And again, these policies have to have the loss occur as a result of an accident. The loss has to occur as a direct result of the accident, typically within 365 days of the occurrence of the accident. It's a relatively inexpensive rider. Again, it has many characteristics in common with the accidental death benefit that we looked at a couple minutes ago. The next rider that we'll look at then is the disability waiver of premium. Disability waiver of premium is actually pretty straightforward. What would happen here is we have a client who's been paying premiums. So we've got paying premiums. This client has chosen to include disability waiver premium in their policy. And there are a couple different ways this can work. Sometimes the disability waiver premium is based on the policy owner. Sometimes it's going to be based on another party, a third party premium payer, depending on the circumstances. Whoever it is that happens to be paying the premiums, let's say that this person becomes disabled. This person suffers a disability. Well, in the next module, when you get into disability insurance, you're going to learn all about elimination periods, but here's our first exposure to this idea, that we're going to say, in most cases, after you've been disabled for 90 days, so your disability lasts 90 days, at that point you become eligible for coverage using the disability waiver premium, and at that point the insurer starts to pay your premiums, and they will continue to pay your premiums until you get better, at which point you would resume paying your premiums. Now, once you hit this 90-day mark, keep in mind that you have been paying your premiums for that 3 months. If you fail to pay your premiums over that 90-day period, your policy will lapse. If your policy lapses, then the insurer is not going to pay your premiums for you. So if you do pay your premiums over those 90 days, you meet the 90-day elimination period, you're disabled enough to be eligible for the disability waiver premium, the insurer will now pay retroactively for those premiums that you paid during that 90-day period. And as a note, anytime you have a scenario like that where you have a number of days to deal with, or you have some sort of a timeline involved, I find it's especially useful on the exam to draw out a timeline. You'll find that dealing with clients later on too, that when they have to understand when a benefit will pay or when it won't pay, illustrating a timeline is a very useful way to achieve that. Okay, the next set of riders we'll look at are all kind of lumped together. These are what we call the living benefits riders. And the living benefits riders, and sometimes these are built right into policies today, that's not uncommon. So with the living benefits riders, if we have certain circumstances arise, and you'll learn all about this in Module 10, but if you have diagnosis of a terminal illness, or of a critical illness, or of a long-term care need, then it might be that you can access some of the death benefit or some of the cash value associated with your policy under the living benefits provisions. It's a sickness benefit. It's going to be paid tax-free. You use that money for generally whatever purpose you need, outside of certain long-term care provisions which can restrict you to only using the money for the provision of long-term care services. But the idea here is you've got life insurance, and we're going to allow you to use some or all of that life insurance coverage in order to meet your needs right now. A very common living benefits provision would be you're diagnosed with a critical illness, you're allowed to now access 50% of your death benefits in advance of passing away, and then when you die, your death benefit would be reduced accordingly. The next rider that we'll look at is a term insurance rider. This is where it's useful to understand a little bit about the results of a needs analysis. So let's say that we sat down with a family, we did the needs analysis, and we figured out that they had a need of $1 million, just to use a nice round figure. So we sit down with this family and they say, okay, we figure you need $1 million of insurance. Great. And we look at their situation, and it turns out that they are pretty investment focused. They understand how investments are going to work. They do a regular job of managing their other investments. They like the idea of seeing exactly where their insurance dollars are going. Hopefully you're with me here and you can see that for that client you might recommend a universal life insurance policy. So we look at their situation, $1 million of life insurance, universal life insurance. It might cost them somewhere around maybe $8,000 a year, depending on their age, as a cost of insurance for $1 million universal life policy. Might be a little bit more than that, might be a little bit less than that, but probably not a lot. So $8,000 a year, the client says, whoa, hang on a second. Not incorrectly, that's a lot of money, $8,000 a year. If you've got somebody who makes $80,000 a year, you're going to take 10% of their salary in order to fund this life insurance need. Now, the life insurance need, it's important, it needs to be met. So we want to make sure that we're going to put in place a provision here that's going to allow for them to purchase the appropriate amount of insurance. Now, we saw that Universal Life is the appropriate product for them, but they're not going to buy $1 million of Universal Life insurance. So how about this? We're going to look at a UL policy, maybe a $400,000 Universal Life policy, which might reduce their insurance costs down to about $3,500 a year. I know you'll look at that and say, if you're quick at math, you'll say, well, 40% of $8,000, that's $2,400. That will use $3,000 a year. It's a little more than what they should be paying proportionately, but as you purchase less insurance, we go into what's called a lower band, and the cost actually increases. Buying insurance is a lot like buying a lot of other things. The more you buy, the less you pay per unit. And then what we're going to do, because $400,000 is not enough insurance, we're going to add a term rider. They need still $600,000 of insurance. That term rider is going to give them lots of flexibility. Normally, a term rider is sold much the same way as term insurance. It'll be renewable and convertible on either a 10-year or 20-year term. And with that term rider now, you might see their cost on a $600,000 term rider. It might be maybe $1,000 a year per annum or per year. So now their cost is $4,000, give or take. There's not going to be any policy fee on this term rider because they're already paying a policy fee incorporated into their Universal Life policy. This is a rider, not a new policy, so it doesn't have any additional expenses associated with it. So we'd say $4,000 a year to get your $1 million of coverage. It's about half what it would have cost you to do the same thing with just Universal Life insurance. Now, it's not the only type of term rider you'll see. It's also possible to add a child rider and a spousal rider. You'll find all kinds of variations on these ideas when you're out in the industry, but basically what you're going to see is that a child rider normally includes something like $25,000 of life insurance per child under the age of 25. The cost is normally very low, and one of the really great things about these child riders is that normally they are convertible into individual coverage for the child without providing evidence of insurability. The spousal rider is normally somewhere between $100,000 and $200,000 of coverage. It's also normally fairly inexpensive, and it's also normally convertible into an amount of insurance for the spouse. So these are both ways you can add a little bit of insurance onto an existing policy. Because they're riders and not new policies, they don't incorporate a policy factor, so they're quite a bit cheaper than if you were buying, say, $25,000 insurance on a child's life. The last rider we'll look at is the parent's waiver. And the parent waiver allows you to put insurance in place on the life of a child, which I know we talked about a fair bit already. But now we say, what if something happens to the parents and they're no longer able to pay the premiums? You have a child who's 14 years of age, something happens to their parents, the child's not going to take over the premium payments. So if you put a parent waiver in place, if you choose this rider, and something does happen to the parents, typically upon the death or sometimes severe disability of the parents, then the child's premiums will be paid until the child reaches a certain age, sometimes the age of majority, or sometimes until they're done post-secondary schooling. So this is a relatively inexpensive rider and a way to really ensure the fact that there's going to be insurance in place down the road. On that note, we're really done with the riders. It is something you have to understand. You'll find in a fair number of the exam questions, you'll be expected to pick out the appropriate product for a client, and that product will include a choice of riders. Or in some cases, you might just be asked to choose which is the most appropriate or least appropriate rider for a client in a particular scenario. So good luck with the questions associated with riders. You will certainly have to know them, and you'll have to know them later on as well. You will have to know them servicing life insurance products. Enjoy your studies, and the next topic we'll be looking at together will be the application of some life insurance products. Thank you very much.